All right, well, welcome to today's webinar. We have Lisa Sappenfield Boyer coming with us today. She's the owner of Boyer Sappenfield Investment Advisors, which started in 1983. She's an investment advisor representative with Cambridge Investment Research Advisors Incorporated, focusing on retirement income planning for accumulation and distribution and other overall financial planning needs for you. So Lisa also, I think this is amazing, had the honor of being chosen as one of the 23 highly successful dynamic women mentioned in the book Financial Services Woman at the Top. So I am Madeline Wolski. I'm the program and event librarian here at Champaign Public Library. And before I start the presentation, I'd like to mention some overall library information that I will reiterate at the end of the program. So the library is now open and we are back to our pre-pandemic hours. We only ask that you wear a mask at all times when you're in the building and practice social distancing. We are also still offering curbside email reference and our Book a Librarian services virtually if you need help staying at home. And if you need to request a session, just go to our website at champaign.org and find our Book a Librarian request form. So with the Zoom that we're using tonight, I'd like to briefly go over some of the features available. So starting at the bottom left of your screen, you can adjust your audio settings like changing your speaker. Moving to the center bottom of your screen, you will see a chat and raise hand option. Clicking on the chat will open or close a chat box on the right side of your Zoom window. We invite you all to type in chat as needed. I will be moderating the chat questions, and whenever there's a natural break in Lisa's presentation, I will let her know of the questions. Also, when you're typing in chat, make sure you're sending it to all panelists and attendees if you would like it to be public, or just all panelists if it's something you just want me to see. So you also have the option of raising your hand to get more assistance, and that notifies me if you need technological assistance, so I might do a private chat with you, or if you have a question and you'd like to ask it vocally, I can unmute you. All right, without further delay, I'd like to go ahead and start Lisa's presentation. And thank you for coming here, Lisa. I will mute myself and allow you to take the throne.
Okay, well, thank you very much. I always enjoy sharing some of the information that can help almost anyone that is in our workforce and trying to become financially successful. So tonight we're going to do just a presentation on, I call them the dynamic duo. There's the 401k and the Roth IRA. Again, both vehicles that we can use to accumulate assets for retirement. And also the Roth IRA can be considered, as we'll talk about later, it can be more of a middle term kind of money. A lot of people are concerned that the money in their 401k really is untouchable because you really don't want to take a loan from your 401k. So there'll be some examples of how Roth IRA can kind of be some middle money if you would ever need that. Just got to put the disclosures through there so everything's compliant. This is our team of advisors here in the Arcola office. We have 2 branches, Arcola and Villa Grove. There are 3 advisors in our office. That middle guy, yep, he's my son. It's his birthday today. And then we also have my sales assistant and another advisor, John Bennett. Those are our support staff with Alyssa and Jesslyn, because a key to having a financial advisor is that we have a staff that can take care of your needs and service things, and just instead of a representative where you have an account with them. Okay, so into the material. For a 401k, why would you have one? Well, it's just one way when you're working with an employer that they say with money, out of sight, out of mind is best, okay? So if the current law is when you get a job, you're automatically going to have 3% of your pay being taken out of your paycheck unless you get a form that says don't take this money out. So that was a big move I think for the whole country, so that, again, everyone has 3% going in automatically. They'll usually pick like a target date fund or something like that if you don't pick your own options. Of course, we'll talk about how much more you can put in and matches in the future, but that's a great start that you would have 3% going in no matter what. And a lot of those will be matched. And why is the 401k so important? We were considered an entitlement society about 40, 50 years ago, where basically almost everyone that retired had Social Security and a monthly pension. They didn't even know they were paying into their monthly pension. Money was going to their monthly pension, They didn't even see it come out of their check, but they would retire and get so much per month from their pension and also have Social Security. So retirement at that time, you pretty much, you end up having retirement because of that. The country changed over in the 70s where those pensions started going away. And now, unless you work for a government type of situation, I think less than 10% of the corporations even offer a pension anymore. So what does that mean? That means we have to have our own retirement. We have to fund it, or we're not going to have retirement income, because Social Security is only going to cover about a third of your retirement living expenses. And we consider your retirement living expenses about 75% of what you're currently earning in your wages. So again, it's up to us individually now to have enough funds at retirement to live off of. What are the amounts that you can put into a 401k? Most people sign up by a percentage. You could also do it by a dollar amount. The maximum that can go to a 401k for 2020 is $19,500 for the year. And unless you are age 50 or over, then you can also add another $6,500. And with that, that sounds like for some people, that's a large amount of money. Those are just the maximums there. Again, most people will start at the minimum. If you happen to start at like 10% when you first get into the workforce and do that for 30 years, you're going to have a really good amount in your 401k. These amounts do not include the employer match. Employers may or may not match your contributions. So that's something that, well, we'll just talk about the match next. So with the employer match, most employers still do match your 401k. So like that mandatory 3% that's going in, most employers will match up to that 3% dollar for dollar. So you put in 3%, they'll put in 3%. Or some businesses will do, if you put in, they'll match you 50 cents on the dollar. So you'll have to put in 6% to get their full 3%. So why are these factors both based on a 3% net contribution by the employer? Well, there are some laws out there that say if they agree to match 3% on all employees, actually the top people can put some into the plan too, and otherwise they can't put in. So that's another reason why you'll see most plans. I have seen some plans that'll do 5% dollar for dollar. Whatever your employer will do, you should put in at least to get their full match. Otherwise, you're giving away free money. If they're going to put in 3% a year, why would you give up a free 3% a year? So net cost to you in that situation would be very important to get the full match. And then some people actually will increase their percentage like by 1% a year till they get up to the higher amounts. But again, that match is just one of the most important things that you can do in a 401k. Some employers will, sometimes they have to, if they're having tough times, they might suspend their match, but that does not mean you should quit adding to your account, because again, you're going to be responsible for your retirement income in the future. Now, if you're putting in your money and they're putting their money in, is any of that available to you? Well, their match is definitely not usually available, okay? Usually their match has to stay in there, even if, for example, you could borrow from your part of the 401k. The match is their money. And again, the employers want to give you a benefit, but they want you to stay working for them. They don't want you to work for a year, take your match, take it out in that scenario. So basically, most employers have a vesting schedule of the maximum is 6 years. So that, let's say that you've got $5,000 in the matching side. At the end of 6 years, if you go to another employer, for example, you can move the money, you would be able to take all of that with you. If you work somewhere 2 years, you've got $5,000 in matching, probably only going to be able to take 40% of that with you to a different rollover or to a different account. So those are things you need to know about the matching. If you happen to change jobs, that would be very important to know that. And then, do you know what you're invested in? 401ks, there's a lot of investment options. Became popular about 10 years ago to use target date funds. a lot of 401ks still have like individual fund options. They'll have a lot of US large stocks to pick from, mid cap, small cap, global, balanced. Or if that's overwhelming to someone, then they pick these target date funds. So for example, if you think you're going to retire in 2035, you can take target date 2035. That's usually if you do not have an advisor or someone helping you with your 401k, and you really you don't know what to do with all those options. So we feel at our office, we do a lot of 401k advising for our clients. It's just part of our service. It's definitely proven with a advisor that you can have a better return over the long term with your 401k. The other thing you want to be aware of in a 401k is if you have any other accounts, investment accounts that are not in your 401k, or let's say your spouse has a 401k, all of those investment assets that could go towards retirement really need to be on one spreadsheet and an advisor advising you on what your fund should be going to and what your spouse's funds could be going to, or based on your other accounts, what should it go to. So again, there's just like anything else, with more professional advice, you get a better return on your money over the long term for that. And does an advisor cost? Sure. There's different ways advisors could be paid. Our particular situation is we get 1% of assets under management. So therefore, like, that incentive is that when the market is going up, our income is going up. When the market corrects, the income to my office will go down because the investments have gone down. So we're definitely vested in trying to get the best return for our clients. And the 1% pays for, again, a full-time staff, a regular advice. Some of you might, like I said, had a representative where basically there's just statements you get in the mail, and the only time you talk to them is if you call them. That would be a representative, not an advisor that is basically looking at your situation individually. The other thing I want to talk about on this slide, that probably should have another bullet point and we didn't, is that there are now a lot of times that we change jobs, or the employer changes the 401k, or they merge. So what happens when you change jobs, or the employer says, hey, we're going to switch 401ks, and so we're going to have an option for you to take your 401k money out. We strongly recommend do not cash out those 401ks. They need to be rolled over. We don't recommend usually rolling them over to the new employer, because there have been very rare situations, but there have been 401k funds that have disappeared, or they may not have good options. If you change jobs, then you should really seek advice from an advisor to do an IRA rollover with those funds. It won't be taxable if the advisor does it on the right forms. Move that money that's sitting in that 401k that you're not working for them anymore. So they don't really have, they're not going to be keeping you up on information and advising you in any way. So if you would roll that over to, with an advisor, to an IRA, which could be the same investments or even better investments, it won't be taxable. And then your account will be overseen by a professional as you continue to add to it over the years, or have more and different 401ks. Let's see, I guess that was a break there for if there's any questions on 401ks. This is kind of a good point to have a break for that. Any questions out there?
We don't have any questions at the moment, but if any do pop up, I will shout them out.
Okay. Okay, now let's see if there's anything else I needed to note on 401ks. Oh, the only other situation on 401ks is when you're actually at retirement. We literally have people that haven't sought out our advice early, but when they retire, the money is sitting there, and then they do kind of go, oh no, this is all I have. What am I going to do with it? And then they seek professional advice right at retirement, which is better than never. And so again, seek an advisor out, because if you want to take an income from that, you'll need someone to put a retirement income plan into place, because all those dollars in your 401k, if you've done before tax, will be taxable. Now, there are options at employers now where you can do Roth 401ks, and we're going to talk about Roth. And there are also some after tax. So again, there is a lot more to it than just, what is best for your situation, I guess, is my main concern. Because this will be, again, a large share of your retirement income. And if you're just working on Social Security, you just won't have enough income to replace what you've been used to acquiring. Okay, so I will go back. Roth IRA. There are actually, now you've probably heard of traditional IRAs that came out in the 70s. There's simple IRAs. There's actually about 7 to 8 different kinds of IRAs. The Roth IRA is in some ways opposite of your 401k. In your 401k, they're taking that out of your paycheck, and it's lowering your income that's going to be taxed. So I'm making $50,000 a year. If I do 10% of my 401k, I won't pay on $5,000 of income. The Roth IRA is the opposite of that. You are going to go ahead and pay your taxes as you go, but then if that money's in that Roth IRA, you will never pay tax on that money again. So where that Roth IRA, again, is totally the opposite. You're paying the tax today, and it does have the exception, you have to wait till 5 years to get all of it. But since you are putting money into a Roth IRA with after-tax dollars, say you did the maximum 7,000, say you did 3,000 in 2020 to a Roth IRA, and it grows to 3,500 in 2 years, and you need some money, okay, or you want some money. Basically, then you can take out your contributions to 3,000 at any time, your contributions at any time without a penalty or taxes. On your growth, you have to wait the 5 years. So if you want the whole account, you have to have had the Roth for at least 5 years. But again, you put money in after tax, that's your money, so you can get that back whenever. So that's why I call Roth IRAs kind of middle money. Your 401k has to sit there till 59 and a half in most situations before you can take it out without a 10% penalty and being taxable. So it's pretty much long-term money. The Roth IRA is a nice complement to it because, again, if you had to have it, let's say you went through all your savings. Well, right now during COVID-19, some of the people that are out of work, if they had been funding Roth IRAs, let's say they're out of savings, they don't know what to do next. Before they would borrow on a 401k and make that taxable and all that, they could go to their Roth IRAs, take their contributions out first, wouldn't even be taxable, and use that funds, and you don't ever have to pay them back. So again, that's why I consider Roth IRAs what we call kind of a middle emergency fund, and a lot more liquid than the 401ks.
Hey, Lisa, we have a
Yes.
question.
Yep.
Could you elaborate on why not leaving the 401k in your old employee plan when you leave the company?
Yeah, what can happen there is you can get off of their mailing list. You can, they're not really keeping track of you anymore. Basically, there have been 401k dollars that are lost. I mean, I had a client where we were like, where are your contributions? And her account, and so basically the 401k accounts can get lost. And if you have the opportunity, you're not working for them anymore, they're definitely not looking out for you. And the chance that you can move that 401k into an IRA into your name, not through the company, an IRA just in your name, then you have complete control over it, and you'll always be able to see your account. That's the main reason why that it gives you total control of your account that way, and you see it, is why what we usually recommend to do that.
Thank you.
Yep. Let's go here. Again, why should you consider Roth IRA? I'm kind of known as a Roth IRA pusher, but what I have to do it is one person at a time. Because a lot of people are like, well, why would I do that when I can put money into my 401k and save income taxes? Well, actually, like for example, right now we are in the relatively lowest income tax rates we're probably ever going to be in. So that's one reason why, is that if you put money in a Roth IRA and they raise the income taxes next year or the next year, which they will do within the next couple of years, we've got ourselves with so much debt, and you have money in a Roth IRA, well then as they raise the income tax rates, that money becomes more and more valuable because you're never going to pay tax on any of that growth. Also, where we find one of the biggest advantages to a Roth IRA is, let's play the long-term retirement income game, because that's what we do, is we're funding our 401k, and I like to have either the Roth 401k or a personal Roth, actually, so the advisor can invest things that maybe not available in your 401k. So you're going along, and then it comes time for retirement. And we're going to take income from Social Security. We're going to take income from our traditional IRAs, set that up on a monthly basis. They'll take, we'll have to figure out what taxes to take out of the monthly income. Well, here's what happens is, and did happen before Roth IRAs, since I've been doing this quite a long time, is that people would call and say, hey, we want to trade cars. Do we have enough money in our accounts? And they would be all IRAs at this time after they've retired. And yes, okay, there's money in there. Well, if they need $20,000, or in this the situation here, it uses $15,000. If they need $15,000, well, you also have to pay the income tax on it if it's in the traditional IRA. So if they were only in a 10% bracket, it was really going to cost them $16,700 to get to that $15,000. And what I saw a lot more of is somebody would want more like 20 to 25,000, and it would take them over 30,000 out of their IRA to get to that money. So for large capital purchases at retirement, the Roth IRAs work really well. And if you have them in your retirement income plan, the other side of that is, say that you take $30,000 off of your traditional IRAs and you're taking income off of everything and you're retired. Well, now as an advisor, I have to lower your income, your monthly income, because you can't take the same amount of income off of, say, $30,000 less money and it work out. So again, the Roth IRAs have really become a valuable tool for retirement. And my real believers, clients have been with me for like, well, one client was with me for like 28 years, and they pretty much, we did our plans all along, and they had accumulated quite a bit in Roth IRAs. And they ended up bought a motorhome, a brand new, really, really nice motorhome with their Roth 401, with their Roth IRA, no taxes. They invested money and it grew to doubled about what they'd put in. So that's what they used it for. I've had clients buy classic cars with it. I've had clients that are retired that will I have a nurse, she's going to finally retire at 70. She has 50,000 Roth IRAs. She's going to use 10,000 a year the next 5 years just to travel on, because that's not part of her retirement income plan, and it won't be taxable for her to do that. So again, hopefully you see the point of where the Roth IRAs can give us a lot of freedom. And also as a backup now, like I said, if you had to have the money before that, maybe you got a really good business opportunity or something along the way, and you're trying to figure out where you're going to get the money. Well, you might have it in your Roth IRA and you might be 45 years old and you can take your contributions back out. Now there is some stipulations on who can add to a Roth IRA. If you have earned income of $124,000 for single or $196,000 for married, you can make the full contributions. So they also made the Roth IRA where a lot more people can do Roth IRAs. There are very few people that cannot do IRAs. I think it's less than 5% of the population or have average incomes, the higher incomes. So the maximum contribution, I think I said 7,000 earlier because I'm over 50, but it's 6,000 for under 50 per year and 1,000 catch up. And once the year has gone by, you can't go back and make that up. So say, for example, you got some money, a small inheritance or something. You're like, well, I'll just do it next year. Well, what you've lost is 1 year of being able to do that contribution. If someone today inherits some money, let's say they inherit $12,000 and it's January of a year. Well, then we could fund the previous year and that current year with the 12,000, 6,000 for each, and get quite a bit in Roth IRAs for them at that time. So it also makes a nice place to put inheritances because again, you're never going to pay any tax with that money. Again, just talking about, again, the contributions are tax-free. You still want to have your other emergency funds also, but it does end up as a backup. And that, again, if you go borrowing out of your 401k, you're borrowing your own retirement income. I've heard people say, oh, we're going to borrow out of our 401k because we're paying ourselves back. Well, the problem with that is then you're losing the compounding of the growth of your money. And the compounding is the most important part of trying to get as much as you can accumulated for retirement. So I really, we'd like to try and also interest rates are very low. Like right now, if a client calls and says, hey, we're going to have to borrow money or something, what are our options? I will send them to the bank first instead of taking it out of 401k and paying the 10% penalty and or borrowing it and paying at a much higher rate plus paying tax on it. So again, just really not positive situation to borrow from your own 401k. And then these are just some hypothetical examples because sometimes it's just really nice to see in dollars. This is just an example if somebody was doing was making $40,000 a year income, and they put 6% to the 401k, and it only had a 5% return. Okay. We would hope that it could get a better return than that if we were doing it, but we're going to look at that scenario first. So let's look at, say, year 10 first. At this point, there'd be 24,000 in, and this is based off a 5% return. And this is simple interest or compound interest, but no variation of a market. Then at a 5% average rate of return, it would be worth about 31,000. And then at the bottom, if you look at a 25-year time period, say somebody, doesn't start their 401ks or whatever till they're 30, and at 55, they would have $60,000 in it in this situation, and it would be worth approximately 120,000 if they average a 5% return. And then we just did another one with this one. I do the same one. Okay. This is 6 versus 4. This should have been, there was an error on this. This is if you're putting 10% of the income in. There's a mistake on the top of this one. Didn't see that. I've seen this slide 3 times. So we're doing 10% a year into the 401k off of a $40,000 a year income. Or if you're making 80,000, it's 5% a year just doing to your 401k. This is not including matches. So at the end of 25 years, there would be $100,000 invested, and the account was worth about 200,000 again with the 5% return. Here's
We have a
yes.
question, if this is a good
Sure.
time.
Yep.
So Claire is wondering if she understood correctly, if she takes her Roth IRA to make an investment, the investment purchase does not pay taxes? Or do you mean when taking them out into my bank account or somewhere I can use it, that part does not pay taxes? So
you invest in a Roth with after-tax money. So you would have, like, say you've got 20,000 in your savings and you want to start a Roth, and you put 5,000 of that money into your Roth. From that time on, that 5,000, all the growth you'll never pay tax on. Does that answer it, Claire?
So is anything specifically tax exempt when filing a tax return?
Oh, the Roth doesn't even show up on a tax return.
Okay.
It doesn't go down as a deduction, but none of the gains ever show up on the tax return unless you break the 5-year rule and take it all out. Yeah, that would be the only time that a Roth would show up on a tax return.
Okay. I think that might have done it. Maybe.
Okay. All right. And this one is a hypothetical 3% contribution to the Roth, or $3,000 a year. Just again, Roths are more like a dollar amount because they're usually with an individual advisor. And again, we're always pushing for them. So even if we can get something started. And again, the other part is, like, right now the banks are paying so little. So as a certified financial planner, we recommend that someone has 6 months of expenses in emergency funds. Okay. Well, instead of all 6 months of it being sitting at the bank at 0%, what we do now is say, have that first 3 months at the bank, in your savings, your checking, I don't care what it is in, at the bank. And then maybe your second 3 months is in a Roth IRA because you can get your contributions back anytime. Now, if they're invested, there is a possibility that the investment could be down when you needed the money, but just gives you a chance that if you never get to that 4th, 5th, and 6th month of emergency funds, then that money is growing and growing without taxes through all the time period that you don't ever use it. And then you can use it, like I said, for other things later. So in this scenario, there was $75,000 invested with only a 5% return. And it's the $150,000 and not owing any taxes on it is going to be, is going to be very valuable at retirement. And also, again, for lump sums. When you want to trade cards, you want to do, like I said, want to do capital purchases at retirement, it's really valuable. So it looks like that's where we're at. Is there any more questions?
Not at the moment. That was incredibly informative, and I need to get a Roth IRA.
Yes. And I guess the other thing I want to say is that people, the terms IRA, Roth IRA, 401k, 403b, those are all IRS terms. Now, what is your money in? Your money in any of those investments could be in CDs, it could be in bond funds, it could be in bonds, it could be in mutual funds, it could be in individual stocks. The investment inside of any of those can be almost anything. It's those names are just like, because people used to think that, they say, well, I bought an IRA at the bank. Well, if you have an IRA, if you bought an IRA at the bank, all you have is a CD. That's all it is a CD. It's, because you can have different options with it. So again, that's kind of confusing sometimes between the terminology of the IRS terminology versus the investment side of it.
Very good. Yeah, this is so serendipitous too, because I just got information on my 401k from my previous employer that I had totally forgotten about.
Yes, we do. We find those, and we've had, like, for example, for some reason, the health profession, a lot of them work like at different jobs in different places a lot. And I had a gal that I found like 3 different retirement accounts for her. And we molded 6 into one, because that's another thing. Money just gets lost.
Yeah.
That's another reason why you have an advisor, is so your money doesn't get lost.
Oh, wow. Yeah. I know even when I had gotten married, it was just so frustrating to like locate. It's like, okay, so how many accounts do you have? What credit cards do you currently have open? What do you mean you don't use an Excel sheet to keep track of all these things?
Well, and again, most people, I think kind of what we do, our specialty again is retirement income planning, because a lot of people just get up and go to work every day. And at any age, I've been doing retirement plans for people since I was 22 and they were 22. And I look back now, and matter of fact, I pulled the first one I did for us out the other day. I found a file cabinet. And when I was in my 20s, and it said for us to have a certain amount of income at retirement, we're going to need, and this is back in 1983, 84, that we're going to need like $1.3 million. And of course, at that point, we're like, my husband made $653.10 a month.
Mhm.
I'm like, well, that sounds crazy, but guess what? If we can only if we can pull a 4.5% income, it takes $1 million to get you 45,000 of income when you retire. So
Wow.
that's why those numbers actually come true. And the compounding is what's amazing. And it really is true that, like, if you start at your first job and you do like at least the 10%, and they match the 3, and you do that with, when you comes time for retirement, you will have what you need in income. You will have it. And if you max it, I've got clients that have always maxed since the day they started working. It's amazing. I mean, how just more secure and options they have. And then the other side is, I have somebody that comes to me literally the 5 years before they retire, or 10, and we still can catch up a whole bunch and make it better than if we didn't do it. And the fact that we can just basically, once we do a retirement income plan, then when it's actual time for retirement, what my retired clients want to know, and this is what we figure out for them, is how much they can spend per month without running out of money. That's all anybody wants to know when they're retired.
Mm-hmm.
And that's what we do when they are retired, is basically take that. Before that, and like my son, who turned 36 today, has been doing this since he was 23 in the practice. He's working with younger people and saying, okay, well, let's have a goal. You make this much per year. Let's say 75% of what you guys make right now, that's your retirement goal. How much do you need to be, what percent do you need to be put into your 401k to get to that? Because otherwise we're doing what we call the white knight theory, which is mean, hey, we'll get up and we'll go to work, and when it's time to retire, we'll be okay, we think. Versus if you have a target, you're automatically going to have more money.
Right.
So, and we're just firm believers in plans. And a lot of people say, oh, we've got an advisor, and nobody's ever done a plan for them. And
Oh,
it's just a big difference in doing a plan and like making some assumptions. And again, they're going to continue to change, but I guarantee you, having a plan and making assumptions is much more better than just, okay, we're going to put this percent in our 401k.
right. So we have one more question. So to confirm, Roth IRAs can take your contributions out anytime without penalizations?
Yeah, your money, because it's after tax money. So again, if you put in 3,000, it's worth 3,500. You can take your 3,000 out at any time, and that's the part that most people, that's why it's a one-on-one situation when we're talking with people. And also, to be honest with you, with CPAs, we've had to, when people have had to take their money out, we've had to show the CPAs sometimes exactly where that language is, because it's kind of confusing the way the IRS writes it. But yeah, your contributions can come back out anytime with no taxes, no penalties.
Awesome. Well, I'm not sure if we'll have any additional questions yet, but are there I don't know, any other tips and tricks for Roth IRAs or? 401ks that you can think of besides maybe finding a financial planner? Or
Well, and
we,
again, there are some different ways with financial advisors. With the younger generation, they're doing what we call the subscription model, where, like for example, my clients, then we basically didn't have near the number. I mean, Stan's already done in the number of retirement rollovers, 401k rollers, more than I had done in 15, 20 years, because people didn't change jobs then. Like, now their jobs are changing all the time.
mhm.
And also that they have the mandatory 401k. So um, there's just a lot of people have lots of different accounts out there that really need to have somebody look at them. And maybe let's say you only have your 401k and you want advice on it. And since we usually charge 1% of assets under management, but we can't get to your money. Well, instead, like John, I know, my assistant, he's doing like a $15 a month fee to look at your stuff every time, or he's got different subscription models so it fits more into what we call the Netflix style.
Yeah.
We got to change it, and it automatically comes out of your account. And finally, our broker dealer, which is ahead of most, does have where you can actually pay with credit card and have it, have your subscription fee deducted, just like, again, all the other services that you're used to on a monthly basis.
Hmm. Well, it's so interesting how affordable your services are. Yeah, I guess as someone in my later 20s, like I assume that it will be so expensive
Yeah,
to
that's what we've got to
financially
get out,
plan.
that it's not. And again, like with the technology, and finally the broker dealers, and we just happen to be, I was at the same broker dealer for 33 years, and they got bought by a company that we just couldn't do it, because our clients would not have been able to get the kind of services and things that we've been doing. So when you change broker dealers, that's something you never want to do, because we had to do what they call repaper,
Mhm.
2,700 accounts. Um, and so it's not something you choose to do, but it's the best decision we ever made. The company
Well,
we're with now as our broker dealer, because we're independent, so we can pick whatever investments we want. But again, we've got that overlay of compliance and technology that we can't afford, on our own, that we pay basically a fee for ourselves. And then we've just been so happy because they've got us stuff approved, like the subscription model and things like that, that have made it very easy for us to work with any type of client.
mhm.
And we don't have minimums at our offices. We don't have minimums because everybody needs help, and we've got it figured out where, we're not going to go in the hole on anybody. But the smallest accounts become, it's so rewarding for me, especially. Like, I've had tons of kids that I started college funds for that have been through college now. I've got clients that started with me when I was 22 years old and telling people I could invest money for them. And I don't even know why they believed me. But it's amazing to see what we've done, and it's very rewarding. Very
Yeah.
rewarding.
So we have another question. What is your advice with the current situation, specifically COVID, if you have a job when you're in your 30s?
Uh, well, that's another good thing about the 401k is, or if you're doing your own Roth IRA, if you're dollar cost averaging. In other words, if you're making monthly purchases because you're getting paid, monthly, or if you just set up a Roth, we would recommend that you make purchases on a monthly basis. Because all it does, it takes in that price of the shares, because the market, I was telling somebody today, a client of mine, that I got in the investment business in 1983. There had not been a war or a stock market crash in 50 years. In 87, there was a stock market crash. In 89, we had a war. And I'm thinking, what am I doing? But what it taught me from early on is that with good, sound strategies, again, long-term investment strategies in good investments, the market's always going to go up and it's always going to go down. But it goes up 80% of the time and down 20% of the time. And to be honest with you, right now it's so easy because you can't afford to have the money at the bank for retirement.
Hmm.
So there are more people looking for other options because you just can't, there's no way you can accumulate money now at a bank. So that's the best part about it, is that just have a good strategy. But again, do you have the right strategy? Another thing that happened to me, why we require all of our clients to give us their 401ks to add to our asset allocation, is because in the late 80s, I wasn't requiring that. And I didn't know, but 4 or 5 of my clients, oh, sorry, I waved at somebody, I'm going by the street, just to have it in a small town. 4 or 5 of my clients at one time, when we had that major correction, 87 in the war, is that I did not realize their 401k investments were in almost the same exact things I had invested them in. So it was a double whammy, and they didn't complement each other. So from then on, we started making sure that we saw the 401ks plus the money we had together, to make sure they're diversified. But again, purchasing on a monthly basis with a 401k with a good strategy. Don't go in and out. I mean, I'll get, out of all of COVID, I got one phone call about somebody that wanted to take their money out of the market. And of course, this is when the market was down 30 some percent. There's only two reasons why you would move in and out of the market like that. If you could go in and out of the market, there wouldn't be a market, for one thing. But the two things are, I tell people, if you're going to get out, then there's either one of two things you're going to do. Okay, the market's here, so you want to get out. So that means, when should you buy back in? When it's even lower. So you're going to have to tell me you want back in when it's even lower, which the reason they want out is because it's low, so they can't do that. The other one would be is if you're never going to invest again. Otherwise, you leave it in the market, you let time take it up, and you just dollar cost average it, because if there was a way you could time the market, and then you'll hear some people say, oh, I got out right in time, and if they did, it was luck. But yet, what they do miss out on, and this has already happened this year, is that the people that took their money out, we didn't have any clients, but people that took their money out, they didn't put their money back in time to get, if you never get the top, you're never going to get the bottom. So they didn't get reinvested to get this that went back up. They're probably still sitting on the sideline. So those are some considerations with the market and volatility.
Very cool. Well, I'm not seeing any more questions, so this might be a good time to wrap up.
Okay, well, I enjoy talking about money.
Yeah, well, once again, thank you everyone for joining us, and special thanks to Lisa. So again, the library is now open and back to our regular hours. We ask that you wear your mask and practice social distancing. We are still offering curbside, email reference, and our book librarian service virtually if you need help at home. To request a session or find more information about our later Money Matters financial series, just visit us online at champaign.org. Once again, thank you so much, Lisa. This was a wonderful webinar, and I have learned so much.
Good.
And yes, we really value you over here at Champaign Public Library, and I'm just wishing everyone to have a wonderful evening.
Yeah, too. Everybody stay safe.
Yes. Thank you again.
You're welcome.
Great. Bye.